In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analysts' predictions are, create a valuation, and find out what our potential return will be, and review then rate the company. Today we are going to look at Crocs. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the 12 key pillars. These pillars are based on the insights and teachings of the best super investors, and what I consider to be the key metrics when evaluating a company. Ideally, we would like to see each of these metrics be at least 10%. The first pillar is earnings per share. This is where we take the net income and divide it by the shares outstanding. For Crocs this is 7% for the trailing 12 months. Now, let's look at the free cash flow, which is the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health, and prefers companies that can generate substantial free cash flow. And here we can see, Crocs have hit our 10% free cash flow target, as it is 18%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. Their revenue is at 5% for the trailing 12 months. Then we come to book value, which is calculated by subtracting the total liabilities from the total assets, and this indicates equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interests of the shareholders at heart. For the last 12 months, their book value is up by 21%. Now let's turn our attention to the management of the business by looking at the return on invested capital and return on equity. These two measures allow us to assess a company's efficiency at allocating the capital under its control. Return on invested capital and return on equity are fantastic at 24% and 48%. Now we move on to debt. And Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow, ideally within 3 years. It would take Crocs nearly 2 years to use their free cash flow to pay off the debt. At present, with the information we have gathered, it tells us that Crocs' key pillars are looking pretty healthy so far, but let's find out more. Help support the channel by tapping the like icon if you have found the information helpful, and click on the notification bell to get alerts about my next videos. Now we will focus on other key pillars which help define an excellent business. So let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is currently at 58%, which is good, as we like to see the gross margin at or over 40%. Next, we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying interest or tax. Peter Lynch prefers companies with strong operating margins when assessing its financial health and competitive advantage. Their operating profit margin is 26% and is much higher than our target of 14%. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for companies which have a free cash flow yield of 5% or higher. So, at 15% this looks excellent. As we are potential shareholders, we will now want to look at the average book value growth for the last few years. This is 132%, with the lowest point being this year at 21%. And lastly, Bill Miller believes earnings growth is the biggest indicator to a company's stock price. The average growth for the last 5 years is very high at 64%. In the comments section, I've included a link to the investors page in the annual report, if you want to check it out for yourself. Now let's look at past historical performance, to give us a better understanding of the company's successes and failures. Looking at the chart, we can see that in 2019, their stock price was about $36. But during the pandemic, their share price dropped as low as $10. After that, the company's share price soared to $180, but during the 2022 market dip, they fell to about $48. Although, we can see since then they have peaked at about $147 in 2023. And in 2024 about $156, and have recently dipped again to about $100. Looking at the overview, we can see the current market cap is $5.90 billion. They are currently generating $4.07 billion in revenue. Their net income is $834.75 million. And they have 58.28 million shares outstanding. At present, their earnings per share tells us that for each share of stock, the company is generating $13.79. Their PE ratio is just 7.35, which is lower than the S&P 500 average of about 28. The overall consensus is buy. However, they are forecasting low single-digit growth over the next few years. On average, the analysts believe that the price target should be about $150. Now I am going to show you how to create a valuation. So, I will use their current earnings per share of 13.79. Now I use a combination of the past growth and future analyst predictions to create the estimated earnings per share growth. To create a valuation, I'm going to give Crocs a 14% growth rate. Then, I am going to give them an estimated PE ratio of 10. After that, I will project these numbers forward by 10 years. Then I will set the return I would like to see from this investment to 15%. This then gives me an estimated future stock price of about $511 per share for its future share price. And then we work out the current value, that Phil Town calls the sticker price, which is about $126. Then we apply a margin of safety. At 25% it gives me a buy price of about $95. It all depends on your personal view, and outlook for the company, as well as the return on the investment you would like to see. Please consider sharing this video with someone you think will like it, and click on the link above to learn how to create your own earnings per share growth model. The return we would receive if we bought at our 25% margin of safety price of about $95 and sold in 10 years' time at our estimated future stock price of $511 would be 448%. But this is dependent on our assumptions for the company being correct. In addition, Crocs don't provide a dividend. If you have enjoyed this video, let me know in the comments section. And finally now, we'll summarize what we have found out about the company. When reviewing the key pillars, Crocs scored just 10.5 out of 12. So I will give them a check. As for the past results, over the last few years their share price has been trading upward, but does suffer from volatility. However, I will give them a check. Analysts are signaling Crocs as a buy, although they are predicting low single-digit growth over the next few years. Therefore, I will give them a cross for this. Using the EPS growth model I used earlier on, we created a buy price of about $95. With the current share price being about $100, I will give the valuation a check. According to Morningstar, Crocs don't have a moat. Therefore, I will give them a cross. My final overall rating is 3 out of 5 stars. I have given this a category A rating within my own stock watch list. And for full disclosure, this is a company I have purchased myself. Thank you for joining me during this stock analysis video, and I hope to see you in the next one.